Welcome back to the channel, everyone. Today, we're diving deep into a fascinating corner of the market, hard-to-borrow stocks and the mechanics of a potential short squeeze. We screen thousands of stocks daily, and one name has consistently appeared on our hard-to-borrow screener recently, demanding our attention: Edible Garden AG Incorporated, ticker EDBL. We're going to break down exactly what makes EDBL unique right now. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with a quick profile of EDBL, Edible Garden AG Incorporated. This is a company operating in the consumer defensive/farm products sector, focused on controlled environment agriculture. They offer various packaged products, including living lettuces like Buttercrunch, as well as culinary herbs like cilantro, basil, rosemary, and thyme. Now, EDBL is a microcap stock with a current market capitalization of just $1.05 million. Looking at recent price action, it's been a turbulent ride. Today, EDBL is down 2.15%. Over the last 5 days, it's seen a decline of 6.17%, and over the past 30 days, a significant drop of 75.76%. Joe chart highlighting price action. However, the volume today tells a different story: 22,938,645 shares traded, which is an incredible 8.0 times its 30-day average volume of 2,861,370 shares. This high relative volume, despite the price drop, suggests increased market interest. Joe volume buzz. What is cost to borrow and why it matters? Before we get further into EDBL, let's quickly explain a critical term: cost to borrow, or CTB. When an investor wants to short a stock, they first have to borrow shares. The cost to borrow is the annualized fee they pay to the lender for those borrowed shares. Think of it like interest on a loan. A high cost to borrow signifies intense demand from short sellers to bet against the stock, or a very limited supply of shares available to borrow, or often both. When CTB fees exceed 100% annually, it indicates extreme scarcity or shorting pressure. Why this stock is hard to borrow right now? This is where EDBL really stands out. Our data shows an annualized cost to borrow fee of a staggering 701.0%. Highlight CTB number to put that in perspective: if you held a short position for a full year, your borrowing fees alone would be more than 7 times the value of the shares you borrowed. This sky-high CTB indicates a severe lack of shares available to short. Compounding this, EDBL has an estimated float of only 0.1 million shares. Highlight foot: that's an incredibly small number of publicly available shares, making them exceptionally difficult and expensive to borrow for short sellers. Our internal composite squeeze score, which combines CTB levels, float size, volume, momentum, and other factors, currently sits at 45.1 out of 100 for EDBL. This means it's on our radar, but it's important to remember that a high CTB does not guarantee a squeeze. It can also mean short sellers have very strong conviction and are willing to pay a premium to maintain their positions. Squeeze mechanics explained. So, what is a short squeeze? It's a situation where a stock's price suddenly rises, forcing short sellers, who had bet on the price going down, to buy back shares to limit their losses or meet margin calls. When many short sellers try to cover their position simultaneously, it creates a rush to buy a limited supply of shares. This increased demand drives the price even higher, trapping more short sellers and creating a cascade effect. For a stock like EDBL with a tiny float and extremely high cost to borrow, any significant buying pressure could trigger this dynamic. Dilution risk check. One crucial factor to consider when looking at potential short squeezes is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This can offset or negate a short squeeze thesis because it increases the supply of shares available, making it easier for short sellers to cover their positions, and it can dilute the value of existing shares. For EDBL, we found no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B in the last 90 days, which is a positive sign for short squeeze potential as it reduces the immediate risk of new shares hitting the market. Recent reverse split watch. Now, this is a very important detail for EDBL. The company executed a 1/4-45 reverse stock split on July 13, 2026, which was just 21 days ago. A reverse split reduces the number of outstanding shares and proportionally increases the share price. Companies often do this to boost their share price to meet exchange listing requirements or improve their public perception. In EDBL's case, this reverse split significantly reduced the float, making that 0.1 million estimated float even tighter after the adjustment. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market reevaluates the new share structure and price. So, with EDBL's reverse split having occurred 21 days ago, we are approaching that roughly 1 month post-split window around August 13th. Though this is a pattern, it is not a guarantee. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you be watching for with EDBL? Firstly, monitor that cost to borrow fee. If it remains elevated or even increases, it signals continued short pressure and scarcity. Secondly, keep an eye on available shares to borrow. If that number dwindles further, it increases squeeze potential. Third, look for any shift in price momentum, especially sustained buying volume that could challenge short sellers. Given the recent reverse split, pay particular attention to volatility around the 1 month mark post-split. Remember, high volume combined with upward price movement is key for a squeeze to develop. Edible Garden AG Incorporated, EDBL, presents a unique and intriguing setup with its astronomically high cost to borrow fee, tiny float, and recent reverse stock split. While the price has been hammered recently, the underlying mechanics of a potential short squeeze are certainly present. This is a textbook example of a hard-to-borrow stock, highlighting the importance of understanding these dynamics. As always, this is for educational purposes only. Do your homework. If you found this breakdown helpful, please smash that like button, subscribe for more in-depth stock analysis, and let us know in the comments if you've been watching EDBL or if there are other hard-to-borrow stocks you'd like us to cover.